In our Investing 101, Jeremy Siegel, a finance professor from the Wharton School of Business, explains how slow and steady wins the race when it comes to investing.
Dividend reinvestment is a wonderful way to build long-term wealth. You specify either with the company or your brokerage to take your dividends and buy more stock. And one of the beauties of that is that when the stock market is down, those dividends buy more shares. So you actually buy more when the stock is down. When it's temporarily high, you'll buy less shares. And that's exactly the right strategy that you should pursue. Buying more stock when it's low, buying less stock when it's high, but continuing to reinvest in the market at all times.
How does dividend reinvestment really work? Can you break that down for us?
The great thing about dividend reinvestment, it does it automatically. You don't have to judge, well, is the market low now, I'm going to put more in. That's really hard because it's so discouraging when the market goes down. But the dividend reinvesting automatically buys those more shares when the price is down, and that proves to be a wonderful builder of wealth in the long run.
One big difference, though, Earl, our parking lot attendant, was totally diversified.
Right.
But with Lendl, now, she could have easily just bought something like U.S. Steel instead of this winning company. Now, Jeremy, none of us, and I think you included, would ever recommend somebody put all of her eggs in one basket and then just sit on that basket.
Lendl took an awful lot of risk. The longer your horizon, the bigger the percent should be in stocks. But you should own some real estate in the long run. And you should have some bonds for short-term emergencies. If you diversify, the data is so clear that in the long run it builds such powerful wealth with so much less risk. So she was lucky, but I certainly would not advocate that strategy for the average person. Okay, then. This just reinforces what we already know, that dividing your investment money very carefully between stocks, real estate, bonds, it's essential. And then beyond that, we know that proper diversification within those stocks is essential. Now, Earl certainly did that. Lendl did neither.
Right.
So my question to you is, do you believe that time is the real magic ingredient when it comes to investing, sort of the X factor?
Stocks accumulate through the years, but they don't give 20 and 30% every year. Some years they'll give 25, some years they'll go down 15. What we do know is their average is about 10% a year. And that takes about 7 years to double their total sum. So the more time you have, certainly the more likely you will do extraordinarily well in a stock portfolio.
Right, but now tell us why, because I think a lot of people want to know, why not just sell General Insurance when it was high? She could have just sold it high and then bought it back again when the stock was down. What is so all-powerful about just hanging on, in your opinion?
What is interesting is that a lot of people try to do that. They say, oh, the stock is high, and they sell it. And one of two things happens. It either keeps on getting higher because over time stocks generally appreciate, or it does go down. They congratulate themselves, but then they never buy it back. After it goes down, they say, oh boy, I made a good decision here. It hits a bottom, starts moving up, and then all of a sudden it's above the point they sold it at. And then they get discouraged and never buy it again. I've seen that happen a number of times to investors.
And at the end of the day, having that patience seems to be what makes super successful investors rich.
Well, think about Warren Buffett. His favorite holding period is forever.
Right, and you can refer again to our favorite superstar, Earl Crawley, who just held on to those stocks.
Thanks, Jeremy.